SUERF, the European Money and Finance Forum, bringing together policymakers, finance, and academia.
Welcome to the SUERF Baffi Bocconi e-lecture on fixed income market liquidity. Where do we stand? 2 years after the US Treasury market dislocation in March 2020, the purpose of our meeting today is to discuss the resilience of the liquidity in major bond markets. And with that, we include cash markets, repo markets, swap markets, futures markets, and so on, and which policy work is underway to improve liquidity. This segment of the global financial system is seeing steadily rising importance due to, for instance, sharply increasing issuance, for instance, the Next EU Generation program, but it has also faced major stress events in recent years. So against this backdrop, key issues for discussion today are, for instance, to what extent is the current decentralized market structure, which heavily relies on dealers, still up to the growing challenges? What can policymakers do to foster market liquidity? Where does ongoing reform in the US market stand? What is the impact of long-term structural trends on the resilience of market liquidity? What does the low interest rate environment, the growing importance of electronic trading, the declining role of bank dealers, and the rising role of non-bank intermediaries such as principal trading firms imply? Do major bond markets need a permanent dealer of last resort? What is the European perspective on bond market liquidity, also in the light of the work towards a European Capital Markets Union? And what does the Russia-Ukraine crisis imply for market liquidity? We will start out the first half hour with a presentation of a new study by Martin Scheicher, advisor in DG Microprudential Supervision in the SSM. Martin will summarize key findings from a study which he prepared recently on bond market liquidity. Then, Cornelia Holthausen will take over to moderate a high-level expert panel on the topic. Without further ado, I hand over to you, Martin.
Many thanks, Ernest, for the introduction and also for hosting this very nice event. So basically, my task for the next roughly 20 to 25 minutes is to provide you with a quick overview of the main concepts of bond trading. So basically, I see myself as providing more or less an appetizer, and then the main course will then be served in the panel, and I'm sure the panelists will also answer all the many tricky questions on this subject. So let's get quickly started. Our case study for this afternoon is an important and I would also say fascinating stress event in financial markets exactly 2 years ago. The outbreak of the COVID shock in the US led basically to a collapse of trading in US Treasuries. So a market which is generally understood as trading the risk-free assets suddenly broke down, and it broke down not because perceived credit risk went up, but rather simply because there were too many sellers and too few buyers, and intermediation capacity then came to a sharp decline. So in general, the smooth functioning of bond markets depends really on robust liquidity, and robust liquidity is driven by the structure of trading. And here I want to point out really one of the key differences between the fixed income space and the stock market. Bonds and also credit default swaps and interest rate swaps are not traded on exchanges, but in a structure which is called over-the-counter, so basically in opaque and bilateral transactions. And here, the key point of the functioning of this OTC trading is it needs intermediaries, and these are the dealers. So Ernest has already mentioned the three interconnected themes for today. So we see rising importance of bond intermediation. We also see a changing structure of bond intermediation over the last decade, in particular, a move away from banks as central pillars of this market towards a more technology-heavy mechanism. And what we have also observed over the last decade, And actually, the most recent event I just mentioned was overall a declining robustness of this intermediation. So we've seen increased stress, and of course, given the central importance of the government bond market, which not only provides funding for fiscal policy, but also the risk-free rate and the vital instrument for our monetary policy, this of course has many policy implications. So let's quickly look at how do we actually define liquidity. So in general, market liquidity is understood as the ease with which a trader can buy or sell at the price close to the current market price. So the main components of market liquidity are the direct transaction costs. So for instance, the bid-ask spread. So buying versus selling, what is the price difference? The speed of execution, so how quickly can I sell a position? Does it take me a couple of seconds, as for instance in certain segments of the US markets, or does it actually take me a couple of days or sometimes even weeks, like in US corporate bonds or also less liquid segments of the European fixed income space? And finally, the third vital component of market liquidity, the price impact. So if I sell, how big is the price impact? So basically by selling, let's say a reasonable position, do I move prices by a lot, or is it just a smaller change? And here again, we need to look at the structure of this market. As mentioned, it's decentralized. So here in the center of the slide, I put together these two concepts. Centralized means an exchange with transparent, anonymous trading via a structure which is called a central limit order book. So basically where the orders and they are all really available to all market participants, and also something crucial, central clearing. So this is a structure which is order driven. And this is what we see in equities or futures. Then on the other hand, we have these decentralized trading structures where we usually see two segments, interdealer and the dealer client. And of course here prices are really not fully transparent to everybody. So there is a bargaining process, and trading is actually usually quote driven. So I call a trader gives me a quote, and then I can still decide on whether I want to trade. And this is exactly what we see in bond and swap trading. And such a decentralized structure needs somebody to intermediate, either a bank or another type of firm which really brings together buyers and sellers. And these are these dealers. So let's quickly look at who are actually the main dealers. These are really typically coming from a group of globally systemically important banks. So these are the usual household names of both European and also US investment banks like Barclays, BNP, Goldman, the two Morgans, Deutsche, Societe Generale or UBS. So really the main intermediaries in these markets, and their role is not really taking outright proprietary positions, but rather to act as a market maker. So this means they have a strong relationship with their clients. Typically, a client only trades with a few dealers, and what bank dealers basically need to do is they need to use their balance sheet, their capital, put their capital at risk. If there are imbalances in the order flow, as we have seen 2 years ago, many people selling, the function of the dealer is really to warehouse these positions until they find somebody else who wants to buy this position. So what this means is, as I said, they use their balance sheet. So cost of funding and access to this balance sheet actually play a role in their decision to how much intermediation capacity they provide. And here, one crucial change since the global financial crisis reforms was dealers face higher capital and also liquidity requirements, and a key measure which seems to affect dealer willingness, and this is something which Darrell is going to talk about in great detail, is the leverage ratio. So in particular, the leverage ratio uses a risk weight of 100%, so it penalizes low risk, high volume activities, for instance, like trading in government bonds or also activities in the repo market. And then another ingredient in this changing story is, of course, the low rates, which have in addition increased pressure on the dealers. So let's quickly look at how the dealers reacted to this rising cost of balance sheet. And here I start with the a very nice quote from an overview paper by Darrell. Basically, he says it's like expensive real estate, so you need to be able to pay the rental fee so that you are represented in this real estate. So what dealers have done is they have really moved away from direct market making, so buying and selling, to matchmaking, so really bringing buyer and seller together. But if things turn out in their best intention, then not really offering their balance sheet, not really warehousing these positions on their balance sheet. One key ingredient in this is active electronic trading. So over the last decade, we have seen also in cash markets, in particular in the US market, but also in some European segments like the Italian government bond market, that electronic trading has really increased in importance. And this electronic trading has actually brought new dealers into the marketplace, and these are the so-called principal trading firms. And so we are very happy to have Matt here, who is exactly working in this sector, so he can give us really his insights into how these new non-bank dealers actually participate in these main markets. And so what we see in the chart on the right-hand side really is exactly this change in how bank dealers approach bond markets. This is an illustration for the corporate bond market. We see sharply rising issuance, blue line, and a sharp fall in their inventory. So really they hold fewer positions on their balance sheet, but they still continue to dominate dealer client trading. So here in this chart, this sort of represents really the main building block of our story this afternoon. We have these two segments, the dealer-to-dealer segment in the center, in this bluish box with bank dealers and principal trading firms. This is what is usually known as fast trading. So they have in many of the major markets, for instance, in US Treasuries, they use also central limit order books. Central clearing is in this market segment not yet so fully present, and they really trade among each other, and this is a high share of the market. The bank dealers act as clearing members in the CCPs. There is secured funding via the repo market, so using the bonds as collateral, which links the dealer segment directly with the main segment of bank funding, the repo market. And then on the periphery, so outside this core segment, we have clients. These are, for instance, asset managers, hedge funds, or also foreign reserve managers, and they trade typically, as I mentioned, only with a few dealers, but not really with other clients. And this is exactly this absence of all-to-all, which distinguishes OTC markets from, for instance, stock markets where everybody trades with everybody via one central limit order book. So given that these clients cannot really trade with other clients, they need a strong degree of intermediation, and also this strong degree of intermediation then implies that trading is actually much slower than what we see in the core. So typically it uses voice or request for quote. And this chart really, as I mentioned, as a building block for our story, will be also the theme for the three presentations on the panel. So basically, Darrell will talk about how an optimal market structure would look like. Matt can then give us his insights into how this actually works at the moment in practice and what is the role of principal trading firms. And then Andreas will talk about the systemic risk perspective on this structure, and also the role more generally of non-banks, not only principal trading firms. So this was a sort of simplified overview. So let's now look in a bit more detail at major markets. And so here in this table, I show corporate bonds, mainly US Treasury off the run, German government bonds, treasuries, and also futures really as a benchmark, because this is not only is the futures market important because it directly links with the cash market, it's also important as a benchmark because this is really where we see anonymous central limit order book trading with central clearing. And so the main point of this table really is to illustrate the links between the types of trading structure which we see, and then trading costs and the impact of the COVID crisis. So we see a quite heterogeneous impact of the role of electronic trading, which directly links with the role of the dealers, which is also quite heterogeneous across markets. So obviously in those markets where the need for intermediation is quite low, because we already have a central limit order book here, for instance, futures is the best example, the role of the dealers is fairly limited, which directly implies that the role of these non-bank dealers, the principal trading firms, is much higher. Then we see the role of the CCPs, and we can also really observe the differences in transaction costs. So for instance, corporate bonds, which I mentioned as one of the slowest segments of the fixed income market, we could see transaction costs of 40 or 50 basis points, whereas in the cash segment, US Treasury on the runs, it's less than 1 basis point. And this really illustrates the difference, how different market structures then lead to different transaction costs. And also, once there is a shock, and here the COVID crisis is our case study to the impact of this shock, where we have seen significant dislocation in the rather slow segments, so corporate bonds and US Treasuries, and much less dislocation, much less stress, for instance, in other segments, and in particular in the futures market. So let's now zoom in a little bit on the US Treasury trading. As mentioned, this is sort of has an iceberg structure, or something like two segments again. So we have on-the-run treasuries. These are the most recently issued treasuries. Given that they are most recently issued, their overall notional is rather small. So it's less than 5% of outstanding US government debt in the form of bonds. But given that here trading really focuses on benchmarks, it is a very, very liquid market with daily volume of 400 billion, bid-ask spreads less than 1%. And in this market also, the banks which used to really drive this market have lost market share to these non-bank dealers, who now account for probably around 60% of market activity. So this is the one segment, small in outstanding notional, but very active, and therefore also very liquid. And then we have below the surface the huge off-the-run treasury segment. So these are older bonds issued some time ago. These account for a notional of more than 95%. And here bid-ask spreads are of course much higher. So even outside the crisis, bid-ask spreads can be above 10%. And what I want to highlight here is also, this is basically the same asset. So it's both times, it's credit risk of the US federal government, which is traded here. But what we see is, from the market structure and from the structure of the instrument, that we have one segment which allows for high frequency trading, and then we have another one which is still largely dealer intermediated and really trading via the phone. So let's now look at the COVID crisis. So our sort of main case study on what happened in March 2020, really. This episode is in best illustrated by the chart on the right-hand side, the top chart, because here we see a pattern which is very rarely observed in episodes of financial stress, and this is that the yield of a risk-free asset suddenly goes up. So we observe the shock hits the market, yields go down, people perform the usual flight to liquidity, flight to safety, but then basically, as there were so many market participants trying to sell this asset, at a certain stage, this really overwhelmed market capacity. And so this is exactly this part here, where yields then increased again. And then the Federal Reserve stepped in. It took on the role of dealer of last resort. So we know very well from traditional central banking, lender of last resort, but here the topic is now dealer of last resort. And then basically after the Federal Reserve stepped in, and also other central banks acted in their segments, Bank of England and also the ECB, then yields went down again. And so all these forced sellers, which basically overwhelmed market capacity, intermediation capacity, then managed to sell their treasuries, and this dislocation really stopped. And we see the pattern of the dislocation also quite nicely in the chart below, where we compare the bid-ask spread for off the run and on the run. And here really, so this is both times a 10-year treasury note, and we really see this sharp gap between the transaction costs of off the runs, so older bonds, and we also see a little bit of a spike in the on the run market. And in parallel, there was also a disturbance in the repo market, but basically this is also something which Darrell is going to talk about. So this was sort of the market dislocation in the US. So let's now quickly look at what happened actually closer to home in the euro area. So here we see a comparison of 3 bid-ask spreads, and we see that the German government bond, actually the transaction costs didn't jump as much as they did for the other 2 markets. Now, in general, the trading of German government bonds and almost all other segments of the cash bond market in Europe continues to be rather slow. So the only part where we really see high frequency trading, where we see the role of something like a central limit order book, is the futures market. And this is actually also the market which is, in particular, the Bund future is a very important derivatives contract, and this is also really the location for price discovery, whereas in the other segments, the activity and the type of market structure, it is much closer to US off-the-run trading than to what we see in US on-the-run. So slower, more use of voice trading and request for quote. There are some electronic platforms, but it's very rarely a central limit order book. So basically, this is one of the main differences between the US and the EU trading. And then in this context, I also want to mention the general process which has started in the EU called the Capital Markets Union. So here there is basically the general idea to increase the resilience of many key segments of the market structure, and one key issue here is transparency, which I will briefly mention in the next slide. Another point which is important to when we talk about comparing US versus European markets, in addition to this, let's say, rather slower level of activity, is also, and this is also one of the recurring themes of our presentations today, the design of central bank operations. And here, and basically Cornelia is best placed to talk about this, given her involvement in many of these programs. The Eurosystem approach is quite different from the Fed. So first of all, of course, the design of the asset purchase programs, but then also a very, very wide range of collateral which the Eurosystem accepts, and also a much larger type of number of counterparties compared to the traditional Fed operations. And what we see here also at the bottom of the slide really is how this, how the volatility, so this is a simple time series based model of the US Treasury on 10-year on the run and German government bonds really behaved over the last decade. So of course, both spiked during the March period, but in general, the volatility of German government bonds has been lower than what we saw in the US. And also in general, there has been, we haven't really observed breakdowns in the no arbitrage relations. So for instance, between bonds and futures. And so with this, I would already come to the last slide, which gives an overview of the main policy measures. And this is of course one of the, will also be the main, one of the main topics in the panel. So the US dash for cash was to a high degree triggered by margin calls of CCPs. And this is actually also something which we now see also in the current market volatility due to the geopolitical tensions. So we see again, in particular in energy markets, very high margin calls. And so really the question is here, is this pro-cyclical or is this normal CCP risk management? And this is a topic which FSB, Bank of England, and also ESMA are working on quite closely. Then I've mentioned the importance of the leverage ratio, so this is also a policy discussion. Really, should we adjust the leverage ratio to reduce the balance sheet burden for repos? Market structure, I mentioned Darrell's work here on the optimal market structure, so he will talk about this all-to-all trading and the importance of central clearing. Transparency, I've also briefly mentioned, is an important ingredient in making market liquidity more resilient, because it means people have more information on where prices currently are. And so here there is a lot of work in the US, and actually in the context of this Capital Markets Union, which I briefly mentioned, ESMA is working on something called the consolidated tape, because at the moment market transparency in many segments of the European cash bond markets is fairly liquid. And then last but not least, central banks. So in particular, there is a discussion on who should have access to central bank operations. So of course, so far it's banks, but should also systemically relevant non-banks have direct access to central bank operations? And more generally, from the central bank perspective, what is the optimal design of the market maker of last resort, in particular to avoid creating adverse incentives for market participants to always rely on a bailout. And with this, I would close my overview and hand over to Cornelia for the panel.
Yes, thank you very much, Martin. So that was a very interesting presentation. I hope the audience learned as much as I did. Good afternoon, everyone. Let me introduce myself. I'm Cornelia Holthausen, Director General in Macroprudential Policies and Financial Stability at the ECB. I have the pleasure to chair this panel today with these three very distinguished experts here today. So let me introduce the three colleagues that are here with us this afternoon. And the first is Darrell Duffie. I don't think I need to introduce you, but I do it anyway. So Darrell is a very highly distinguished financial economist. He's currently the Adams Distinguished Professor of Management and Professor of Finance at the Graduate School of Business, and also professor by courtesy at the Department of Economics at Stanford University. And he has more than 100 research publications on a wide range of topics in finance, and many of his papers have provided cornerstones of key areas of financial economics. And he has also been president of the AFA in the past. Now, Matt here has spent his career at the forefront of the fast trading. He's the founder and CEO of Headlands Technologies, a global quantitative proprietary trading firm that is headquartered in Chicago. Headlands Technologies is one of the largest futures trading firms in the world. And before joining Headlands Technologies, Matt was co-CEO of Citadel Derivatives Group, which is an affiliate of Citadel Investment Group in Chicago. And during the 5 years running CDG, he helped build the world's premier market making and trading firm. Prior to Citadel, Matt was president and CEO of Iceland ECN. That's the largest electronic stock market in the United States. Matt holds a BA in economics and political science from Duke University. And I hear that Matt is also a former world-class fencer. And then last but not least, let me go to Andreas Schrimpf. Andreas has an extensive track record in policy relevant research on the role of intermediaries, exchange rates, and the intersection of monetary policy and financial markets. Andreas is head of the financial markets in the monetary and economic department of the BIS. Prior to this position, he served for several years as a secretary to the Markets Committee in Basel. Andreas' work is published in leading academic journals, including the Journal of Finance, Review of Financial Studies, and also the Journal of Financial Economics. So with these introductory words, I would like to start the first round with the panel. Darrell, the first I would give the floor to you. So Darrell, as just shown by Martin, we have observed a major dislocation in the US bond market. Could you give us your views on the causes and then also the ongoing reforms? As you have been closely involved in the US policy reform process, we would look forward to learning from you about this, what can be called a unique episode in financial stability and its main lessons. The floor is yours, Darrell.
Cornelia, thank you so much. What Martin described, he got to the essence of the concern. And what I want to do today is to give you my perspective on not so much what happened, but what we can do in terms of improving the market structure. So this is one sample of the core problem with the market. This is a histogram showing frequency of months in which a given amount of treasuries from offshore investors are traded with US dealers. And you can see that in a typical month, about $1 to $1.5 trillion of treasuries are exchanged between foreign investors and US dealers. So it's a very large liquid market. If you look to the far right-hand side of the horizontal axis, you'll see a tiny red blip at about 2.7 trillion. That's the month of March 2020. And in that month, an enormous amount of treasuries were liquidated by foreign investors. So, what happens when this volume of trade is attempted to be liquidated in such a short time span? What happens, as you can see in this diagram, which I'll explain, is that all of these trades, not just from foreign investors, but including domestic investors, about $10 trillion in the month of March, must go onto the balance sheets of the largest dealers in the world. Not all of them are American. There are foreign primary dealers as well. But the largest few American dealers are handling essentially the vast majority of these trades. And every single trade by an investor who's not a dealer must pass through a dealer balance sheet. In the interdealer market, and consistent with Martin's remarks, the dealers have a way of sharing the positions with each other on a central limit order book that's operated by BrokerTec. Buy-side investors can trade, those are the blue customers shown of the green dealers. They can trade either directly with dealers or through multilateral trade platforms like BrokerTec, like Bloomberg. But eventually all of their trades must pass through a dealer's balance sheet. And when such a large volume of trade has to pass through those balance sheets, the dealers' balance sheets are clogged up. They're basically limited by capital requirements and also economic risk limits that are placed on the government securities trading desks of these dealers, just at a time when every other desk is calling to the global treasurer of these largest dealers asking for more balance sheet space, meaning a larger capital allocation. The treasuries desk is calling, the derivatives desk needs more space for collateral and derivatives positions. The loan desk is experiencing a huge surge of demands to draw on credit lines. And the treasurer is going to say, no, you're at your limit. We can give you some space, but you can only handle, you're limited in the amount of space that we can give you. They're not going to issue new equity to expand their balance sheets on a very short notice. So exactly as suggested in Martin's opening remarks, bid-offer spreads expand. In this chart, which comes from the Congressional General Accounting Office, you can see that the off-the-run bid-offer spreads, as Martin indicated, were the most affected. But even on the runs were heavily affected, but off the runs, the bid-offer spread went from normal, very liquid levels to more than 10 times, in fact, more than 15 times the bid-offer spread, because it's exactly the off-the-run securities that large investors have been holding for a rainy day. They want them for a safe haven, and apparently they did not get their safe haven. They had difficulty affecting trades, and when they did get trades, they were getting weak prices and volatility was high. Yields were growing rather than shrinking as normal. The market was simply dysfunctional, and the official sector in the US agrees that market dysfunctionality was a significant problem, not just for a day or two, but for weeks until late April. And this is despite the fact that the Central Bank of the United States came out with all guns blazing, providing massive amounts of liquidity and purchasing almost $1 trillion of treasuries within a few weeks to try to reduce these balance sheet problems that the dealers were having. They were trying to offload from the dealer balance sheets. So we should not assume that a central bank can take care of this problem when it comes up, and that we don't need to improve the market structure, because even when the Fed does come out and fully accommodates as much as it can, the market will still remain dysfunctional, and precisely during a period in which investors needed a safe haven. Even on the interdealer order book markets, market depth plummeted. Here, let's take the New York case of the 10-year US Treasury. The quantity of bids and offers within 3 ticks of the midpoint on the order book was typically between 150 and 200 million leading into early March. And once it was realized that balance sheet space would be highly limited, the dealers were only willing to offer very, very small amount of accommodation. High frequency traders were, contrary to what's commonly viewed, were not pulling out of the market. They maintained the level of liquidity that they had been providing, but because of the huge increase in the volume of trade and the fact that the dealers could not expand their balance sheets to accommodate that sufficiently, neither the high frequency traders nor the dealers in combination could handle the flows. So let me attempt to diagnose the problem, which we can map over the preceding 20 years. If you go back to 1998 and look in the vertical axis in trillions of dollars at the red bars, these are the sizes of the balance sheets of the holding companies of the largest US primary dealers. I'll cover the global primary dealers in a moment. Now, if you look at these red bars leading up to the financial crisis, they were tripling between 1998 and 2008. The largest dealers were not subject to very restrictive capital requirements, we learned to our disappointment. And they were also getting very cheap funding because they were viewed as too big to fail. And that cheap funding was like jet fuel. It expanded their balance sheets rapidly. And there was plenty of capacity for handling the huge flows of treasuries that occurred during September and October 2008. That was not a problem. However, once regulators realized that these largest dealers were not sufficiently capitalized, dealers were then subjected to significant capital requirements, and their balance sheets did not grow. Moreover, their funding costs, because they were no longer viewed as too big to fail, their funding costs rose, and basically there was not much incentive for dealers to grow their balance sheets, whether through equity or debt funding. However, if you look at the blue bars, the treasury market did not stop growing. Of course, it kept growing even faster because of the need to fund the enormous deficits coming out of the great financial crisis. And then the COVID crisis hit, and the treasury market has been growing even faster yet. So we're facing a situation in which the treasury market is growing by leaps and bounds, but dealer balance sheets are not growing. And as I mentioned a moment ago, all trades must pass through a dealer balance sheet, which means this is not a sustainable trend. In the future, when stress markets occur, it will be an even more difficult situation than in March of 2020, unless the market structure is changed. This is the same story with a different scale on the vertical axis. This is the ratio of treasuries outstanding to total primary dealer assets, not just US primary dealers, but all global primary dealers in US treasuries. And you can see that leading into the 2008 financial crisis, the amount of treasuries per unit of dealer balance sheet was shrinking. The market was not overwhelming the dealers, just the opposite. The dealers were growing more than sufficiently rapidly to keep pace with the growth of treasury markets. After 2008, under the new regulatory regime, dealer balance sheets were unable to keep pace. And this trend will continue. What was a $20 trillion market at the eve of the COVID crisis is projected by the Congressional Budget Office to be a $120 trillion market by the year 2050. Just think of that, $120 trillion market, and still dealer balance sheets will not have been growing very quickly. So let me go quickly to what I believe is one of the key elements of market reform that will be able to expand the capacity of the market to handle stress market flows. And it's a very significant change. First, I want to describe the current market structure with respect to central clearing. Now, if Cornelia, for example, is customer one of dealer one, and she's buying treasuries from that dealer, that could be JP Morgan, and Martin is customer two of dealer one, and he is selling treasuries, you would expect that the buy trade and the sell trade could be netted off if dealer one could transfer those commitments to settle trades to the central counterparty of the US Treasury market, which is the Fixed Income Clearing Corporation. Unfortunately, the market is not structured that way. Those commitments to Martin and to Cornelia must remain on the dealer's balance sheets until the trades are finally settled, which could be in 1 day, 2 days, 3 days. It can be delayed because of the very congestion itself. These trades can be delayed, and meanwhile, they're building up on JP Morgan's and the other major dealers' balance sheets. Between the dealers, it's possible to centrally clear, but that doesn't handle the huge influx of trades coming from the buy side. Only about 20% of trades in the US Treasury market are currently centrally cleared. This is the market structure that I would point toward and is indicated in the G30 report that was recently published under the chairmanship of Tim Geithner. In this diagram, Cornelia and Martin are also hooked up to the central counterparty for the US Treasury market. And when the dealer conducts the trades between them, it can novate those trades directly to the central counterparty, relieving its balance sheet to handle yet more trades. This can be done with straight-through electronic trade processing, and it can encourage exchange operators to begin offering all-to-all trade services between Martin and Cornelia and all of the other buy-side investors, the major buy-side investors in the market, so that they need not necessarily trade through the largest dealers. They could trade in an all-to-all framework directly with each other. So in that case, the dealers would never need to touch some of the trades, and that would allow even further increase in market capacity. Let me briefly say again the two methods, the two channels by which having broad central clearing reduces the commitments of dealer balance sheets and increases market capacity. Number one, the dealers are able to net buy commitments against sell commitments and relieve balance sheet space through netting. Number two, exchange operators with the benefit of central clearing in a broad framework can offer exchange services so that ultimate buyers and ultimate sellers can trade directly with each other, never necessarily needing to trade through a dealer balance sheet. So numerically, what are the effects of this kind of central clearing? Well, subsequent to the COVID crisis, Michael Fleming and Frank Keene at the Federal Reserve Bank of New York ran a counterfactual analysis of the actual transactions that were flowing through the US Treasury market. The blue line at the top indicates that peak commitments to settle of the dealer balance sheets were on the order of $1 trillion on peak days in March of 2020. That is a lot of balance sheet space. Some of that doesn't count towards regulatory capital requirements, but it all counts towards economic commitments. And the dealers were limited in terms of how much space they could get for both regulatory and economic capital. I'm colorblind, but I believe the line below is either green or yellow. And that indicates that in a counterfactual world in which all significant trades are centrally cleared, the commitments to settle such large positions shrink by about 2/3 to around 300 trillion per day. That is a very substantial reduction in the commitment of dealer balance sheets to settling treasuries trades, and it makes it possible for them to handle a lot more trades. There's also an issue with settlement failures. Settlement failures means that when, let's say, Cornelia fails to deliver the treasuries that she promised to the dealer, that the dealer is unable to provide the securities that it promised to Martin, and there will be a chain reaction of settlement failures. These are not events of default, they're simply IOUs. JP Morgan will tell Martin, I'm sorry, I owe you some treasuries, I'll get them to you when I can. In the meantime, JP Morgan's balance sheet is tied up with settlement fails, and Martin is unable to process the trades that he promised to others. These settlement failures grew from normal levels of between $1 and $200 billion a week to on the order of $500 billion a week in the worst weeks, about 1.5 trillion of settlement failures in the 3 worst weeks. That is a lot of congestion, dysfunction, and unnecessarily committed dealer balance sheet that would be dramatically reduced by central clearing, because if the trades are centrally cleared, then there's no chain reaction. All of the trades are settled at the same place, the central counterparty. Here are the results from Fleming and Keen's study. 74% of fails in specific issues are effectively of these daisy chain types that could be paired off and eliminated with increased central clearing. The percentage of fails that pair off tends to be higher when fails are higher, and in those issues where fails are higher. Expanded central clearing not only reduces the balance sheet resources needed for intermediation through reduced settlement fails, but those benefits are the greatest when they're most needed and for the securities for which they are most needed. Let me finish with a list of some of the key recommendations in the G30 report to which I contributed as an advisor. And I'm not going to try to give full justice to the entire report. I'll just spend my last minute quickly running through the key steps that were recommended. First, a cost-benefit analysis of broad central clearing. This is a big undertaking, and the G30 report concluded that the US government should carefully analyze the costs and benefits of doing this. Secondly, a measure that was almost immediately after the G30 report, perhaps by coincidence, was adopted by the Fed, which is a facility that provides financing to those that don't need to sell their securities, they simply need cash in the repo market. By the way, if we have a chance for discussion, I will suggest that this will help, but it will not cure the problem that some investors really wanted to sell their positions. Number 3, because of the importance of the soundness and operational efficiency of a central counterparty, G30 recommended a review of the design, operation, and regulation of the Fixed Income Clearing Corporation. If you ask the central counterparty to handle a larger fraction of trade, you want to make sure that it's safe and sound, and you want to make sure that its rules don't prevent investors from being able to get their trades cleared. And that's there's some complications there to discuss. Number 4, one of the reasons that dealer balance sheets were so impacted is a rule called the leverage ratio rule, which is controversial not only in Europe, but especially in the United States, where it has been gold-plated by a factor of 2 relative to Europe. Those supplementary leverage ratio rules tie up dealer balance sheet even if there's no risk involved. Even, for example, with central bank deposits, a substantial amount of dealer balance sheet space must be meet a capital requirement that's not necessary. Central bank deposits are completely safe. They don't need a capital requirement, and they tie up the amount of space available for intermediation. Number 5, shockingly, and contrary to MiFID II in Europe, in the United States, transactions of US Treasuries are not reported. And that makes it difficult for investors to understand what is the going price, which dealers are likely to be providing the best price, and when I'm offered a price, is it a good price? Should I accept it immediately? That reporting has been delayed, and I'm very disappointed in the US authorities that they have not brought about the availability of transactions reporting there is no, despite the suggestions by some market participants that transactions reporting would reduce the liquidity of the market, all of the evidence available suggests that that's not true, and it has improved the liquidity of the corporate bond market with minor exceptions. And then finally, in order to improve the access to all-to-all trade venues, expansion of the Securities and Exchange Commission's regulations on treasuries trade platforms, which currently do not, or if they're trading treasuries, they're exempted from fair access regulations that allow those platforms to deny or make it difficult for investors to access them, and encourage a more closed interdealer network of all-to-all trade that's not open to non-dealer investors. As I mentioned earlier, if all-to-all trade is possible, then dealer balance sheet space need not take up 100% of investors' requests for liquidity. So with that, I want to pass it back to you, Cornelia, and thank you for the opportunity. And I look forward to further discussion.
Thank you very much, Darrell, for this very insightful presentation. Now let's change perspective quite a bit, and let's go to Matt. So Matt, you have had a long and distinguished career in trading. For many in the audience, probably this principal trading firm, the PTFs, is still pretty much unknown how it works. So given your unique perspective, could you maybe give us your view on the business model of PTFs and also your experience in the events that have now been 2 years ago? Thanks very much.
Thank you. My name is Matt Andresen. I'm the CEO of Headlands Technologies, which is a leading principal trading firm. Martin asked me to participate today and specifically to provide what he called a view from the principal trading floor. I thought a nice opening visual would be to give you guys a visual of what the trading floor looks like. In 1995, this is what the principal trading floor looked like. These are the locals from the Board of Trade trading Treasury futures. This is what Treasury trading looks like today. It is all done electronically. And in the futures markets, critically, it is centrally cleared. As we heard from Professor just a moment ago, when markets are centrally cleared, in crises, all the liquidity runs to those markets because of the capital efficiency of those markets. Brief background on who the heck Headlands Tech is. We've historically run two businesses. The original and largest was and still is a quantitative proprietary trading business that trades and concentrates in very liquid instruments that are electronically traded and centrally cleared anywhere in the world. We also started a market maker that we called Headlands Tech Global Markets, whose job was to go after less electronic and liquid markets with the idea that they might become more liquid and electronically and centrally cleared. And so we went after and focused on the municipal and corporate bond markets in the US. And we built a leading franchise there. We were #1 across all major venues. While we were #1 when COVID March happened in 2020, not only were we #1, our market share quadrupled. And we were essentially alone in these markets as others pulled back. This was very good for the market. It was very good for our brand, very good for our profitability. The sad part of the story is that, unfortunately, as again the professor noted, all trades must eventually go through a dealer balance sheet, and the dealer balance sheet that the municipal world is reliant on is Pershing Bank of New York. They're the only ones that do it. As amazing as that sounds, as a result of the financial crisis regulations, we're down to one vendor, and that vendor had some sort of existential crisis or just a panic. And in late March, literally took up haircuts by up to 10 times. which eliminated everyone's ability to run a balance sheet in this business. And so after this, we decided that we needed to marry the business to someone with a voluminous balance sheet. So we ended up selling that business last year to Toronto Dominion, which is the largest Canadian bank and has, I believe, the highest rated balance sheet in North America. So it was very good for the team that ran that business, but frustrating to me was I would have loved to continue building and running the business. But unfortunately, those issues that we've heard about today, they really do matter in the real world. All right, so what does our other business do? So to do quantitative proprietary trading, to make markets electronically in ways that necessitate tens of millions of orders placed a day, you got to have at least a decade of pristine market data that is timestamped down to microseconds or nanoseconds. You have to be a world leader at quantitative modeling and especially expertise in machine learning. And then you must also have high performance computing expertise. And this is necessary both for running high resolution experiments and then also to actually effectuate your trading in a low latency environment. And once you've mastered all these things, you do have to implement your trading strategies in a fully, what's known in industry parlance as a black box. And what that means is human beings don't touch or interact with the business during the trading day. The machines, who are dispassionate, who aren't subject to emotions or fear, they continue running their strategies based off your experiments and simulations, and you don't try to overlay any human intuition, which is notoriously awful. And then what do we trade once we built all this? As I mentioned, we trade basically anything that is liquid, centrally cleared, and electronically traded. And that can be futures, stocks, bonds, or futures. All right, the second thing Martin asked me about is intermediation and stress periods. What's that like? Although I am in electronic trading, I've been around electronic trading since its infancy, so I've seen all kinds of stress periods. I saw the dot-com bust in the US, I saw the great financial crisis, I saw long-term capital management, and of course saw COVID. So, and now we're seeing a bit of a little stress with the current geopolitical stresses in Eastern Europe. So, what is it like when it's all kicking off? So the advantages of intermediation in these liquid electronic centrally cleared markets is that if you've done your modeling over at least a decade, your modeling includes prior stress periods. So you don't have to sort of tune your markets for fair skies. You can tune them for any kind of weather and then rely on them on that modeling to carry you through. As I mentioned, there is no panic for the machines. Sometimes when we watch what our machines are doing, we scratch our heads, but we trust in the models and we trust in the simulations. Typically, when these things happen, two things result during extreme stress. Volumes will spike and spreads will increase proportionally to volatility. So if you think about what an intermediary is doing, is they're being paid to warehouse risk, and that charge for that is contingent, just like an insurance company, on the relative risk of a disaster happening. And in a moment like, say, the last couple of weeks, the odds of something chaotic happening are much higher, and so the price for that goes up. But as long as that price can float freely, there's still a price that where supply and demand will actually meet. How do markets react to stress? It really depends on the structure of the market. On these markets that we concentrate in, they handle things wonderfully. The equity markets, back in 1987 during the stock market crash, human specialists didn't even answer their phones at the NYSE, and just trading froze up, and they didn't start answering the phone until the bottom. And then they took all those sell orders and made a fortune. If you fast forward to the great financial crisis, by that time, my company Island and others had changed the U.S. stock market to be fully electronic. And as a result, when the great financial crisis happened, while trading in the bilateral phone markets like mortgages or auction rate securities or the like completely locked up, the trading in stocks, options, and futures traded like water, and they exploded. When Bear Stearns and Lehman hit the wall, no one worried about their stock book or their futures exposure. They only worried about their bilateral exposure. And in some good ways, we have learned this lesson with central clearing. In others, like in the US Treasury markets, we appear immune to these lessons. If you wonder how things react to stress, well, if prices don't change, if the spreads didn't incrementally increase, that just means there would be no supply because there'd be no one willing to do this. We see this here in the United States every time there is a hurricane inbound to the southeast United States or a snowstorm in probably also the southeast who's not equipped to handle it. This is what the grocery stores look like. And everybody goes and hoards, and we get things like COVID supply chain problems. We believe that the price for these things should fluctuate based on supply and demand, and that if you try to artificially constrain that, you just run out of the stuff sooner. Venezuela, they have the greatest proven oil reserves in the world, but they also have draconian price controls, and as a result, you can't get gasoline there perversely. Humans often completely understand the supply-demand price dynamic, but in some parts of the economy, they accept it without question, and others, they think it's anathema. An example I always make is airline tickets. If you, back when we used to be able to fly on airlines, you'd get on the airline ticket, you would never ask your seatmate, hey, what did you pay for this ticket? And then get angry if, oh, well, I paid $100 for this ticket. I bought it a year ago, and if you perhaps had a business emergency and had to buy this last minute, you paid $1,000. No one asks because everyone accepts that this is a rational way to do things. However, when Uber first started replacing taxis in New York City, the biggest taxi day of the year and the biggest Uber day of the year is New Year's Eve. No one wants to drive. They want to go out drinking, let's say. They want to have someone drive for them. When Uber introduced what they called surge pricing, which is just pricing, supply and demand, the supply of drivers on New Year's Eve maybe goes up a little bit, but the demand explodes. As a result, the price of these rides should go up. But New Yorkers decided that this was terrible and un-American to allow surge pricing. They should get rid of it. And of course, once they got rid of it, there were just no drivers, because why would you pick up someone and let them vomit in your back seat for a low price? It doesn't make any sense. So the way this manifests in our markets is when you hear the anecdotes from large institutions about how they perceive liquidity in stress times, they always say, oh, it goes away. And what I believe what they really mean is they define liquidity as, I want to dump an infinite amount of inventory onto the market at my cost basis. The market owes it to me. That's not going to happen. When stress happens, it's because there's a dramatic repricing of asset, and the market is going to change the price, and you can always sell it. You just have to sell it at a different price. So the reality of market stress is, again, these markets have to move to assess the new information. And during these times, spreads, they will respond inversely to the volatility, which is a healthy mechanism that ensures that the markets continue to function. And if you look in COVID, the markets that allowed this to happen, like the centrally cleared markets, like stocks and futures, handled COVID wonderfully. They didn't happen in these other markets. And you can see this in the spreads and the liquidity of the Treasury futures versus the Treasury cash. So the conclusion I would ask you to consider is that we must make sure that where possible we have electronic and centrally cleared markets. and I share the frustration of my fellow panelists about how we haven't pushed this through on the cash treasury side. And then I would always ask that, and again, with many academics on this call, I know I'm in good company when I say we should always rely on data and not anecdotes when coming up with policy recommendations. So those are my remarks, and I'll turn it back to Cornelia for my next panelist.
Thank you very much, Matt. So a very different perspective, but not necessarily different conclusions. So let's go to the third speaker. That's Andreas. So you and the BIS, you have done extensive work on the changing structure of systemic risk and the rising role of non-bank financial institutions. So one key question for policymakers is typically the contribution of market liquidity to systemic risk. So could you please describe your analysis and any policy lessons?
Yes, first of all, thank you very much, Cornelia, for the introduction and also for the invitation to be on this panel. So in my presentation, I will basically make the case why liquidity risk matters from a systemic risk perspective, and especially so in a financial market system where when non-bank financial intermediaries dominate. And this is pretty much where we have gotten to since the great financial crisis, given the structural changes and some of the regulation that we have seen that others have previously pointed out. I also would like to make the case that these changes mean that liquidity crises have become more prevalent. And so indeed, that means also that quite a bit needs to be done in terms of policy measures to tackle these issues, and I will get to that in my presentation. At the beginning, let me just first start with a bit of a high-level perspective on some of the key changes in the structure of intermediation since the great financial crisis. So here on this slide, I'm using data from the US flow of funds, looking at the total assets of various important sectors here on the left-hand side. And we focus on the blue line here, which is the security brokers and dealers, which we typically associate to be the main intermediaries in fixed income markets and other key OTC markets like derivatives and also repo markets. We really see there massive growth that took place prior to the GFC, sort of starting from the mid-70s and so on, and then it really outstripped the growth in other sectors, for example, also total assets by commercial banks over the same period. And pretty much after the collapse in the GFC, that sector has more or less hasn't really recovered in terms of the overall assets. On the right-hand side, we're showing the leverage measured as assets over equity for the securities brokers and dealers. And we see also that in the period prior to the GFC, it really it was to a large extent the expansion in leverage that drove asset growth, and we've seen a massive drop in the crisis, and then also leverage has come down significantly. So if one would look at this graph sort of from an old frame that it's the broker-dealer sector that matters, one would have the impression that market-based intermediation has essentially been in retreat. But that is not true. It just simply migrated elsewhere in the financial system. And so to show this, here on this slide, I have a flow chart. It is also somewhat similar to some of the charts Martin showed earlier, where on the right we have the ultimate savers in the economy, on the left we have the ultimate borrowers, and in the center we have the various kinds of financial market players that intermediate these financial flows and that matter for these flows. So we have the market intermediaries, and then in the center the financial market infrastructures like exchanges, platforms, and CCPs. And then on the right, we have institutional investors like hedge funds and asset managers. And so the broker-dealers here highlighted in green, they used to be a key as intermediaries, but they're now essentially just part of a broader mosaic of players that matter for fixed income market liquidity. We already had the discussion on principal trading firms. They have become much more important for buying and selling of securities and shifting risk around seamlessly, in particular for on-the-run treasury securities, but also in the futures market. Then the other set of entities that have become much more important are CCPs, especially for the derivatives, futures, and interest rate swaps. Less so for the cash segment, but their role has also massively increased. And then also other key players, asset managers and hedge funds, have become much more important for warehousing risk and holding risk. And importantly, also these players, they have some notable liquidity mismatches on their balance sheets, and also sometimes, depending on the business model, they also employ significant amount of leverage. So what this means is that the traditional intermediaries that form part of banking groups, they're now part of this, they've ceded the ground to the new players, the non-bank financial intermediaries that I've just shown. And as a result of this, in particular, given also these liquidity mismatches and leverage, the spikes of liquidity demand stemming from the non-bank financial intermediary sector has arguably increased. At the same time, the supply of liquidity is no longer really the domain of the broker-dealers. They're much more constrained in doing so, as also Darrell has highlighted. But it involves, in a symbiotic fashion, I would say, PTFs and hedge funds in particular, those that engage in relative value trades. And that type of liquidity, however, I would also argue is more of an opportunistic type of liquidity provision, unlike the liquidity that's provided by dealers where client relationships matter much more. So overall, these changes imply that the scope for liquidity imbalances in the system has arguably risen quite a bit. And overall, that makes it also much more important to manage liquidity risk, and it also matters much more from a financial stability perspective. Now, so on this slide, I would like to make the case that the provision of liquidity to a large extent is resting on leverage. So we're plotting here on the horizontal axis the change in assets of the broker-dealer sector, and on the vertical axis the change in debt and change in equity. And one can really see that it's really when the assets change, it's not that equity would change. It's really a one-to-one relationship with debt. So it basically means that ultimately it is leverage that is underpinning very much the capacity of the market intermediary to lend its balance sheet. And what's enabling this is I mean, the mechanism through which this operates is typically through compression in margins. So when the margins go down, that in turn allows for greater leverage and for a given amount of equity to finance larger positions. And so if we're then taking a look at the old frame of how we would have thought about systemic risk sort of pre-GFC, typically the focus was on defaults as the main stress propagation mechanism. So one bank that had borrowed from another bank, and that other bank had in turn borrowed from yet another bank. So in this sort of, let's say, interbank market, one default would easily cascade through the system and have knock-on effects on others. But the point of my presentation is that in this new normal where non-bank financial intermediation dominates, it's not necessary for defaults to feature in the stress propagation mechanism for systemic risk. There are other channels as well that can be quite potent. And in particular, I would highlight one that we emphasize in a recent paper with my colleague Sirio Aramonte and Yun Shin. And the starting point there is again the role of margins that limit the use of debt financing, and in turn also define the debt capacity of the market participant. And then the mechanism, the key stress propagation comes when margins spike, for example, when volatility spikes or when correlations change, and when they are changing in a vehement fashion, in particular after periods of compressed margins. That in turn may kick off a deleveraging spiral. It reduces debt capacity in the system, and in turn, it also means that intermediaries find it harder to support. They don't have the support for market liquidity under these conditions. And so we get some spillover effects, which can in very adverse circumstances also feed an entire spiral. And the key point here that I would like to highlight is that this means that there's a close connection between leverage and market liquidity that is important to take into consideration. Now, what are the implications of these structural changes for liquidity? As I said, risk is increasingly warehoused outside of the banking system under the new normal. So we expect greater spikes in liquidity demand. Also at the same time, liquidity provision has become more fragile. As a result of this, we expect liquidity crisis to be more likely, and with more the non-bank sector being closer to the epicenter, and less of the banking sector, because the banking sector has been made more resilient because of the reforms. So what can one do about it? I think it's important to consider a whole range of holistic, to look at it from a holistic point of view and consider a whole range of policies to address the issue. Key would be to rely on ex-ante policies to reduce the incidence of these liquidity demand spikes that I talked about, in particular by promoting adequate levels of self-insurance in their respective non-bank sectors. I also would agree with Martin earlier that addressing pro-cyclicality in margins is going to be extremely important. Because it affects system-wide debt capacity and liquidity, and can generate these very strong effects, these strong deleveraging effects that can be harmful for the system as a whole. And then when it comes to supply of liquidity, it's important to really make the nodes in the system more flexible. That means really having well-capitalized banks, that buffers are usable, and that the plumbing is robust. The market infrastructures are there, and that includes also CCPs, of course. Last, let me turn to another key implication of the changes that we have discussed, and that is the role of central banks in this new environment. It's important, in my view, that they have an operational toolkit in place where they're able to address the root problems in markets, and that may mean also potentially expanding counterparties to the non-bank sector as well, in order to restore functioning in certain market segments if necessary. But it's also important that this toolkit is well calibrated and well designed, because ex post interventions in particular, they come with a series of side effects, and in particular, there are issues around calibration, alignment with the monetary policy stance, etc. There are also plenty of communication issues that could complicate matters quite a lot, and so it's very much important to design these tools very well. And then there's another issue when one is expanding the backstop arrangements to include a wider set of counterparties. I think it's important also to take into consideration the impacts on leverage and risk taking that comes from the provision of access to the central bank balance sheet. And so in order to essentially avoid moral hazard and such type of risk taking, it's also important that that regulation moves side by side with any changes to the operational toolkit. In particular, I mean, we would call this as a quid pro quo. So in order to also ensure that that the central bank is protecting its risk, and in particular the risk also ultimately for the taxpayer, very well. So with this, let me just stop here at this stage. Thank you very much.
Thank you very much, Andreas, for providing it a different, very interesting perspective. So we are almost ran out of time. Maybe each of you could just quickly reply to what others have said, and maybe Darrell, you could start. And so I mean, in particular, I would also be interested in hearing what you think about the PTFs that Matt described. Do you think that they can provide stable liquidity? Do you think these type of market players are regulated enough? And then I see in the chat there's also a question on your views of CCPs and whether they are really resilient to stress, because they are very large. We don't want them then to fail in this circumstance.
Thanks, Cornelia. I'll go very quickly because I know you're low on time. I found a remarkable level of consistency across the remarks by Martin Scheicher and Andreas and Matthew and myself with respect to the causes and potential mitigation through central clearing and other methods. And all-to-all trade, the market structure needs to improve. On the point that you asked about, Cornelia, the principal trading firms are currently providing liquidity, but they do not increase their provision of liquidity on stress days. They simply continue to do high-frequency trading. They don't carry positions overnight. The main problem there is not the damage they're causing and not the fact that they pull out and under stress. They don't do that. It's that they are not adding to overnight liquidity provision, and they're not safely being cleared and settled right now. Their trades are being settled on the books of the, informally on the books of the interdealer brokers like BrokerTech, which is acting as though a central counterparty. It's a buyer to the PTFs and a seller to the dealers on those trades. And the interdealer brokers are not regulated as central counterparties. This informal type of central clearing is just not acceptable for safety and soundness, and it's asking for trouble. Most regulators agree that these trades should be centrally cleared. Mm-hmm. So I think that that's the message that I would leave on, with respect to the PTFs.
Thank you very much, Darrell. So Matt, would you have any reply? And also, I mean, what would be your view on the potential measures to support market liquidity that other colleagues of the panel have suggested? And yeah, this question of behaving opportunistically, as Andreas called it, would also be interesting.
First of all, I think it's not something we need to speculate about. So there is plenty of data on this. We have stress periods from throughout the great financial crisis, from the dot-com crash, from the Grexit scare in 2011, from Brexit, surprise election, the Trump election. I mean, there's been any number of test cases for what happens under stress, and the answer is always a couple of things. First, that the markets that are centrally cleared, electronically traded and quoted, they handle stress the best. The second thing is that the principal trading firms are usually not only do they not leave, they're usually the only ones that don't leave. So if you looked at the municipal and corporate markets in March, we were alone in those fixed income markets, literally alone. typically they run these requests for quote auctions in those markets. And historically, we would see, we were by far the largest respondents. We would typically be in an auction with 7 other people. Okay, so that was the average number of respondents to an auction. In peak COVID, it was 1.5, and we were the one. So the entire market in aggregate was half of what we were doing. So, and I think this plays out throughout these different markets and examples. And I do want to just respond to something the professor said. Principal trading firms in 2022, they typically trade 23 hours a day. So overnight is only an hour. And so everyone holds positions overnight. And the positions do typically scale with the size of the opportunity. So in stressed environments, it's perceived that the opportunity is greater and you will flex the positions up. But the best way to incent the primary dealers to stay in this market, I believe, is to first get them out of the balance sheet business when it comes to the clearing, let them net it down by forcing central clearing upon them, which they have fought steadfastly, and then make things, have electronic order books, which will force them to either compete in that or cede that function to the principal trading firms.
Thank you, Matt. You're here in the presence of many people of the public sector, so I guess there's always a bit of wariness about institutions that are not regulated as much as others, and that we know less about.
So let me say one other thing I should have responded to, which is that there is this perception that we are regulated less than other firms. I would be happy to, in another forum, to debate anyone on that topic, because I believe that we are the most heavily regulated business on earth, and that includes nuclear power and anything else in non-financial parts of the economy. I'm regulated by every self-regulatory organization, such as exchanges or FINRA, by every national regulator, by every central bank. We respond to inquiries from these regulators on a daily basis. So given their outsized percentage of the market firms like mine represent. So we're heavily regulated. We would welcome the Treasury market to join the rest of the world in moving on to a centrally cleared platform, but all of the activity is still extremely heavily regulated.
Yeah, thanks. Maybe Ernest, he can take it up as an idea for future discussions. So Andreas, last but not least, I'd also like to give you the floor, and then Martin also, if there's still time.
Yeah, if I could just address one of the points that Ernest has written in the chat about the channeling of transactions to CCPs. No, I mean. So if I understood also Darrell correctly, I mean, you're arguing for, okay, it needs also quite a bit of further study, of course, costs and benefits. And I would just like to point out maybe a few of the costs and the potential limits. No, so one is that the netting efficiency is likely to be presumably quite reduced in a period when you have a generalized stress event, when the market is very one-sided. So I guess that is something one needs to consider as well. And the other thing is, I mean, this entity would, especially if the netting benefits are supposed to be very large, it's essentially going to boil down to one CCP for the entire Treasury market. And so we're concentrating a lot of risk as in one entity, and it would have to have some very significant liquidity resources and backstops. And so a question would then be if one can even leave that to the private sector to run a CCP like this, or if it even has to be the public sector that needs to provide it. But I guess otherwise there are a lot of important further issues to be addressed when it comes to CCPs, and in particular the issue of avoiding the excess procyclicality in margins. There are quite a few of interesting and very relevant tools that are being proposed, like for example minimum initial margins or some countercyclical margining tools. but they need further study and importantly also a more wider application. Let me just stop here then.
Yeah, thank you very much. I thought that was very, very interesting. Thank you for being so open and sharing your views. I would hand back to Ernest. So thanks very much for your participation. I thought that was really good.
Thank you very much. This concludes our e-lecture and panel on the state of play in fixed income market liquidity. Let me give a special thanks to Martin for taking the lead in organizing this event, and to all speakers and to Cornelia for your valuable insights. I really learned a lot today. This concludes today's SUERF Baffi Bocconi event. Thank you for your interest. Bye-bye and take care.
Bye-bye.
Thank you.
Thank you. Bye.